Howdy, Jacob here. Today we're looking at Evercommerce in the software industry, 2.2 billion market cap, 2.6 billion enterprise value. Still trying to find their operating margin. Looks like most recent year they have achieved it, but they have very high gross margin, over 60%, over 65%, with revenue growth still growing heavily. Most recent year, the revenue growth dampened quite a bit, but even 8% year over year is still very impressive. I presume there's some R&D spend, and we do see that over 10, probably around 10 to 13% of their revenue is being expensed as R&D. Again, taking money from today, hopefully getting more in the future. Not guaranteed, but that is a great way to reinvest, find different ways to reinvest and possibly get greater returns in the future. So that's not bad. It's not a bad R&D expense rate. 93 million cash on hand, 6 million short-term debt, 527 million long-term debt. That 500 million debt is going to be a good amount of their free cash flow, but they're a largely growing business. I mean, I'd prefer when you grow a lot. I mean, it's tough to issue shares as a shareholder, but I mean, it's more risky to have debt. With that said, again, they are starting to produce free cash flow and it is growing a lot. And so I wouldn't be surprised if they were making, if they didn't issue more debt and they just double their free cash flow. Now 3 years their free cash flow is going to be their debt. So I just don't want them issuing more debt at this point unless it's extremely advantageous. But for now, their use of cash, at least recently, has been acquisition a little bit. Majority of it is share repurchases. So I think that's enough to get me to make my own assumptions here. So they provide integrative software as a service. I mean, just massive growth opportunities. I think there's also a lot of competition here, but it seems like they're making their way to be able to compete. And so I think 10% revenue growth seems pretty reasonable to me. 20p price free cash flow, given that a lot of opportunity to grow. Very likely, even still at the end of 7 years, if they grew 10% a year, they're maybe a $2-3 billion business in revenue. That's nothing. So, still pretty small there. Net income margin. I mean, they haven't had much on the net income side, but let's do a big range. Free cash flow of 15. I like that. Net income, let's say it gets to 10. Share repurchases, 1% is about 22 million for them. And offsetting stock-based compensation would put that at about 60 to 70 million. So majority of their money is going to share repurchases. I think I'm fine with that. And given these assumptions, we're saying it needs to fall 41% before we get the return we're looking for here. So again, you don't really know about their earnings margin. I do prefer free cash flow margin, and so I'm basing my projections on margin off of that. And if they are able to keep that 15% margin, grow 10% a year for the next 7 years, have a 20 multiple at the end of that period, buy back 2% of shares, it's not looking too far off from a price that could be attractive, especially if they can grow more than this. So I hope you enjoy this video and have a great day. Thank you.